seismic shift has occurred in the silver market, and it's being driven by the financial giant JPMorgan Chase. For years, this institution was seen as the gatekeeper of suppressed silver prices. Yet, in an unprecedented move, JPMorgan has switched sides, and the scale of its actions signals a monumental transformation in the precious metals market. This isn't just another market maneuver, this is a calculated pivot with massive implications for silver investors and the global economy. Let's break it down piece by piece and explore why this could be the beginning of the end for silver price suppression. On December 9, 2025, an article in the Economic Times dropped a bombshell that should have rocked the foundations of every financial newsroom. JPMorgan Chase, the same bank that had spent decades quietly suppressing silver prices, had just executed a game-changing move. This is the same institution that was fined $920 million for precious metals manipulation, and the same one that stood at the center of the largest naked short position in commodity history. But now, things had shifted drastically. Between June and October of 2025, JPMorgan unwound its massive 200 million ounce paper short position in silver. But they didn't just pull out, they went on a historic buying spree, acquiring an eye-watering 750 million ounces of physical silver. Yes, you read that right, 750 million ounces. That's 3/4 billion ounces of silver, not in paper contracts but in real metal stored securely in vaults. To give you some perspective, this is nearly equal to an entire year's worth of global silver production. It's more silver than many countries have in their strategic reserves, and at today's prices, it's worth about $22 billion. What's even more astounding is that this is just their entry position, long before silver prices truly take off. This isn't a speculative hedge fund making a bet, it's JPMorgan with $3.9 trillion in assets, positioning itself for something far bigger. For decades, JPMorgan was the key force holding down silver prices through the use of paper derivatives. Traders even gave it a name, the JPMorgan short. Whenever silver tried to climb past key levels such as $30, $35, or even $40 an ounce, enormous sell orders would mysteriously flood the market, suppressing any upward momentum and sending retail investors scrambling. But now there are no more short positions. For the first time in history, JPMorgan is not only long on paper silver but also long on physical silver simultaneously. This isn't just portfolio diversification. This is a bold declaration of their strategic shift. They've flipped sides and they know exactly what's coming next. Here's what they figured out before anyone else. The days of paper manipulation are over. The mathematical realities of the silver market have shifted irreversibly. Let's take a look at the 3 key dominoes already falling, each one making the next more inevitable. First, physical silver has all but disappeared from the market. Silver lease rates, the cost to borrow physical metal, skyrocketed to 35% in October 2025. Banks are so desperate for silver that they're paying a premium just to hold it for a few months. One insider even told Bloomberg that silver lease rates have hit 20 to 30% just to borrow metal for short periods. This is no ordinary market stress. This is the kind of systemic breakdown that precedes a major collapse. The second domino, the actual physical metal available for delivery on the Comex has plummeted to 15-year lows, even as paper contracts have surged. Currently, for every ounce of silver available for delivery, there are 2.44 paper claims on that same ounce. This is no longer a functioning market, it's a ticking time bomb where more than half of the participants will be left without a chair when the music stops. Third, industrial demand is ramping up in a way that can't be ignored. In 2025 alone, technologies like solar panels, electric vehicles, 5G infrastructure, and data centers consumed 1.2 billion ounces of silver. Unlike investment demand, which can pause during economic downturns, industrial consumption is locked in for years to come. Manufacturing lines won't stop for lack of silver. They need it to build everything from solar panels to semiconductors. JPMorgan saw these 3 trends converging, and the conclusion was clear: the manipulation game is over. The bank that made billions suppressing silver prices has now deployed $22 billion to accumulate the physical metal, because they know that the fundamental dynamics of the market have permanently changed. They're not just positioning for a short-term trade, they're positioning for a long-term transformation. And here's the most chilling part: their timing couldn't be more telling. JPMorgan's flip coincided perfectly with the US Mint's announcement that they are running out of silver coins. Think about that for a moment. The US Mint, backed by the world's reserve currency, can't source enough silver to meet retail demand for American silver eagles. If they can't secure physical silver, what hope does the average investor have when trying to convert their paper silver ETF shares into actual metal? This is the signal that a seismic shift is underway. The biggest predator in the silver market has stopped fighting against rising prices and has instead positioned itself to ride the wave they've spent decades suppressing. Silver is currently trading at $64.47, which is already a record high. But if JPMorgan is willing to deploy $22 billion at these levels, imagine where they see silver going when the supply crunch becomes undeniable to the broader market. Unlike the Hunt brothers' failed attempt to corner silver in 1980, JPMorgan is holding physical metal, no leverage, no margin calls. They've positioned themselves in a way that makes them untouchable, even by government intervention. The silver market has fundamentally changed, and JPMorgan is poised to profit from it in a way that the rest of the market hasn't yet grasped. This is just the beginning. The question now is not whether silver will explode from here, it's whether you understand the message that JPMorgan just sent to the market before the rest of the world catches on. When you are JPMorgan Chase, an institution sitting atop nearly $4 trillion in assets, woven into every major financial artery on the planet, you don't operate within the same reality as retail investors. You don't wait for CNBC confirmation. You don't worry about timing entries to the dollar. You move markets by deciding where liquidity flows. You make calls others can't. You offer premiums no one else dares to match. You structure off-market deals that quietly pull metal out of inventories the public is told are unavailable. That behavior isn't defensive hedging. It isn't fiduciary housekeeping. It's the unmistakable signature of an institution whose internal models are no longer projecting volatility, but structural repricing. JPMorgan didn't want exposure to silver. They wanted possession. As much physical metal as possible, secured before the repricing becomes visible to everyone else and premiums spiral out of control. Critics inevitably reach for the Hunt brothers comparison. The story is familiar. Silver spikes, regulators intervene, the corner collapses. On the surface it sounds convincing. But structurally, the two situations could not be more different, and those differences determine how this story ends. Nelson Bunker Hunt and William Herbert Hunt amassed roughly 200 million ounces, largely through futures contracts layered with leverage. They controlled paper silver far exceeding their actual capital base. When silver touched $50 in January 1980, regulators changed the rules mid-game. Margin requirements exploded. Position limits were rewritten overnight. Silver Rule 7 froze new longs while shorts were allowed to operate freely. Credit lines were cut. Margin calls hit. Forced liquidation followed. The collapse was swift and unavoidable. JPMorgan's position is built on an entirely different foundation. They control 750 million ounces of physical silver, purchased outright using balance sheet capital, not borrowed money, not leveraged contracts. Physical metal in private vaults doesn't receive margin calls. Under U.S. law, warehouse receipts represent legal title. The government cannot force liquidation of privately held commodity inventory without invoking emergency powers. This is not an attempt to corner silver through manipulation. It is advanced positioning ahead of a supply failure. And that distinction matters more than anything else. Silver is now deep into its sixth consecutive year of structural deficit. According to the Silver Institute, global demand exceeded mine supply again in 2025 by more than 117 million ounces. That deficit is not hypothetical. It already exists. Industrial demand alone reached approximately 1.2 billion ounces last year, driven by solar, electric vehicles, data infrastructure, and semiconductor manufacturing. These sectors don't pause orders because prices rise. Their supply chains are locked in years ahead, and silver has no economically viable substitute at current price levels. Layer investment demand on top of that. ETF inflows surged throughout 2025 as inflation protection became a priority. Retail buyers faced coin shortages and premiums reaching double digits above spot. Meanwhile, central banks, especially within the BRICS bloc, continued diversifying away from dollar-denominated assets and toward hard commodities. The system's buffer is gone. This is where stress becomes failure. Comex registered inventory, the silver actually available for delivery, has fallen to roughly 40 million ounces. At the same time, open interest represents more than 240% of that physical supply. In practical terms, if just 4 out of 10 contract holders demand delivery instead of cash settlement, Comex cannot fulfill its obligations. That isn't market turbulence. That's functional insolvency hidden behind settlement mechanisms. JPMorgan understood this long before it became obvious. They deployed $22 billion at prices averaging $60, $65 per ounce, not because silver is cheap, but because their internal models show that current prices are irrelevant compared to where the system must clear. History provides a baseline. Silver's 1980 peak of $50 equals roughly $185 today using official CPI. But CPI no longer reflects real inflation. Using the pre-1990 methodology, the one later abandoned, that same price translates closer to $600 per ounce in today's purchasing power. That's not speculative math. It's consistent methodology. Now compare contexts. In 1980, leveraged speculators attempted to control 200 million ounces. Today, industrial demand alone consumes 6 times that amount every single year. And that demand is structural, not speculative. Material science research shows that meaningful substitution only becomes viable at silver prices measured in the thousands per ounce. JPMorgan isn't betting on a spike. They're modeling the end state where paper claims collapse, physical scarcity dominates, and price rises until supply is rationed only to the highest value users. Reasonable scenarios unfold like this. Supply-demand rebalancing alone, $100, $150 silver. Delivery stress forcing cash settlements, $200, $300. Paper market failure and physical repricing, $400, $600 plus. At $100 silver, JPMorgan's position becomes $75 billion. At $200, it becomes $150 billion. Those aren't speculative returns. They're institutional endgame numbers, the kind that justify decisive action before consensus forms. Now focus on the calendar. January 2026 marks a convergence point. China's silver export controls become enforceable, granting immediate authority to restrict exports without notice. China exported 660 tons in September 2025 alone. A halt would remove global supply overnight. JPMorgan must return an estimated 4,000 tons of leased silver to ICBC. Sourcing that metal without disruption may prove impossible. Metaller, one of the world's largest refiners, returns to the market after withdrawing during October's freeze. If feedstock is unavailable, the shortage becomes undeniable. Then comes February 2026, when the March Comex delivery cycle begins, the first major stress test of the year. With inventories at multi-decade lows, even modest delivery demands could force the exchange into a binary decision: source metal at any price, or admit it can't deliver. Here's what JPMorgan understood while accumulating, and what wasn't explained publicly. The paper silver market is already broken. The October 8th London freeze exposed it. Lease rates exposed it. Mint shortages exposed it. The math exposed it. While retail investors were told silver was finished, institutions were quietly taking possession. That $920 million manipulation fine wasn't justice. It was the cost of doing business. Prices were suppressed. Physical metal was accumulated. And now, the institution that held silver down stands ready as the system reaches mathematical limits. Silver at $64 looks expensive, until you understand why JPMorgan just secured 750 million ounces at that level. When the dominant predator abandons suppression and positions for scarcity, it isn't speculation. It's confirmation.